Hey everyone! Today I want to talk about a topic that affects every single one of us, the Federal Reserve's interest rate hike. Now, you're probably seeing all of these headlines about the Fed raising rates, but what does that mean for you and your money? We're going to break it down, but first, let's start with the basics. The Federal Reserve, also known as the Fed, is the central bank of the United States. Its role is to promote a strong and stable economy, so it keeps an eye out on several economic indicators such as unemployment, consumer prices, and gross domestic product or GDP. They have many tools at their disposal to ensure a stable economy, and one of their main tools that they use is setting the federal funds rate. The federal funds rate is the interest rate at which commercial banks charge each other to borrow money overnight. By law, banks must maintain a reserve equal to a certain percentage of their deposits in an account at a Federal Reserve Bank. If for some reason a bank doesn't have that reserve requirement, they can borrow from other banks to meet that requirement. If a bank has an excess of their reserve requirement, they can lend that out to other banks. This ensures that banks have money to cover depositors' withdrawals and other obligations to ensure financial stability. The federal funds rate is one of the most important interest rates in the US economy. It impacts broad monetary and financial conditions, which in turn impact your purchasing power, your debt, job security, investment portfolio, and the overall sentiment and direction of the economy. So, whether you realize it or not, the Fed has a very big influence on you, your money, your lifestyle, and your future. In the past few months, the Fed has been raising interest rates to curb inflation and push it back to its target of 2%. Now, the current inflation rate based on data ending December 2022 is 6.5%, and the current federal funds rate is 4.5 to 4.75. The federal funds rate is important because it sets the tone for all of the other interest rates in the economy, such as those for mortgages, credit cards, savings accounts, and anything else that requires borrowing. And when the federal fund rate changes, it can have a ripple effect throughout the economy, impacting not only borrowing costs, savings rates, and the overall economic growth. So, what does that mean for you and your money? Let's look at the ways the Fed's interest rate hike affects our finances. The first impact of the Fed raising rates is that it is now more expensive to borrow money. But why is that the case? When the Federal Reserve raises the federal funds rate, it becomes more expensive for banks to borrow from each other, which can impact the cost of borrowing for businesses and consumers. Now, commercial banks commonly use a combination of the federal funds rate plus 3 to determine the prime rate. And the prime rate is the interest rate that banks will charge their most credit-worthy corporate borrowers. The prime rate closely tracks changes to the Fed funds rate, and banks will pass on these changing costs as they pay to meet the reserve requirements. So as the Fed rate increases, so does the prime rate. So as borrowing happens on multiple levels, from bank to corporate business to smaller business, and then finally to the average consumer, that's you and me, the interest rates that we get charged for borrowing will increase and have already increased because the federal funds rate has increased. This means that there are now higher rates for short-term loans like your auto loans, your credit cards, adjustable rate mortgages, and any other industries that rely on financing. So what does it all mean for you? If you are considering taking out a loan in this year or the next, you will likely feel the impact of these higher rates, which can result in higher monthly payments and more of your money going towards paying interest. And what you need to do is be aware of that and plan for that and plan ahead and maybe put off borrowing. If you have high credit card debt, you want to be paying off that debt as fast as you can, as the interest rates on your purchases are likely rising. Changes to credit card interest rates can be 2 billing cycles behind, so you want to ensure that you have a plan in place to pay down high interest debt. This is any debt with interest in the double digits. You may want to consider doing a balance transfer to take advantage of introductory rates, but please read the fine print when you do a balance transfer. You want to make sure that you absolutely pay off your loan before your terms offer expire. Otherwise, you might go back to higher rates, and you don't want to be doing that for your debt. Keep in mind too that interest rates climb faster for borrowers perceived to be riskier. And how do banks know if you're a risky borrower? It's through your credit history and your credit score. So over time, you also want to be diligently working to improve your credit history and your credit score, because doing so can save you a lot of money in the long run. A good credit history and credit score follows you for the rest of your life. So if and when you decide to take out a loan years from now, having that robust credit history and score will pay off. Just a quick note on mortgages. The Fed doesn't directly affect mortgage rates, but the federal funds rate and mortgage interest rates are driven by very similar macroeconomic forces. Typically, the rates banks charge for a 30-year fixed rate mortgage reference the 10-year Treasury bonds, which is impacted by any other kind of Fed policy. So, while it's harder to predict rates in the future, it might be best to review your current financial situation and your desire for a home and see if it actually makes sense to make a purchase today, lock in that purchase price, and just refinance for a better interest rate later on in the future. The second thing I want to address is that if you are in school and are thinking about staying for grad school, I want you to consider your costs as well. Look at the interest rates on any of the debt that you are going to take on for school. Because higher interest rates are here, most likely to stay for a few months or maybe a year or so, you want to be aware of what interest rates you will be paying on any kind of school loan debt. Staying in school instead of opting for a paying position may mean you miss out on the opportunity to earn income, the opportunity to invest that income, the opportunity to use that income to pay existing debt, and you will also likely, if you stay in school, be digging yourself a bit more into debt. It's always good to think about your future self when it comes to borrowing money. Borrowing money now is expensive, and do you want your future self to be paying down that debt for a longer period of time? Higher interest rates means more of your money is going towards interest and not to the principal, which can take debt repayment a little bit longer than normal. If you found value in this video, consider giving it a thumbs up, share it with a friend, and subscribe to Sisters for Fi for more money content so we can help you build a life of impact for yourself, your family, and your community. The next impact of the Federal Reserve's interest rate hike is a decline in your purchasing power. Now, for many of us, the average consumer, inflation has been extreme the last few months. It's declined a little bit, but it has not been down to the 2% that many of us are used to, which means our dollar isn't buying us as much as it used to. As of December 2022, the inflation rate was around 6.5%. So there are still many households are still experiencing that pinch for their money. Now, on top of higher prices, if your household has taken on debt at these higher rates, you now have less money to spend on a monthly basis because your monthly payment has increased. This will mean that there's going to be just a little bit of tightening in your budget. As households' purchasing power declines, it means less spending overall. And when businesses see that there's a shrinkage in the demand for their goods, businesses will start to feel the pain. They will start either to increase their prices to make up for that loss, or they will implement some cost cutting measures that will affect job security. We will cover how the Fed's interest rate hike affect job security in the next few minutes, so stay tuned for that. As an average consumer, we need to be keeping an eye out on our everyday spending. This may be the time to really be diligent about your budget because your dollar isn't going as far. And it may be time to pull back on some of those wants spending and instead put money away for the just in case. The next impact of the Federal Reserve's interest rate hike is actually a positive one. And if you are a saver, this is something that you can take advantage of. Because the price of overnight borrowing between banks has increased due to the Federal Reserve's interest rate hike, it becomes more expensive for banks to borrow from each other. So what banks will try to do is instead entice average consumers like you and me to deposit funds into their accounts. And they will do this by increasing the rates on savings accounts and CDs. And if you are a saver, this means more money in your pocket for the money that's sitting in those bank accounts. With the higher cost of borrowing, you may end up postponing taking on new loans, which means you now have the opportunity to save more and earn more on your savings by putting your money into a savings account that provides a high yield interest. What you want to be doing is shopping around for a high yield savings account that offers you higher interest rates on your savings. Online banks and online high yield savings accounts will offer these higher interest rates than your regular brick and mortar. So you want to be looking around and shopping if you need to move your money to these places where they're offering you better rates for saving. Now, fairly easy to shop around for rates online. You can go to bankrate.com to check what the latest rates are. But of course, make sure you're also looking for things like fees, minimum deposits, and withdrawal requirements so your money doesn't get eaten up by those other charges. With interest rates on savings accounts at a higher rate, this might be the perfect time to increase or start your emergency fund. This is if financial instability arises and you want a cushion for yourself. Your money isn't going as far anyways, so it might be prudent to save it just in case. If you want to learn more about emergency funds and how much is a good amount, check out this video where we deep dive into emergency funds. The next impact of the Federal Reserve increasing interest rates is the impact on your job security. Now, raising interest rates is not an easy tool. It simply slows demand, and there's really no way to fine-tune its impact. And unfortunately, one of the impact of raising rates is unemployment. But how does that happen? How does raising rates impact your job security? Well, we covered that it is now more expensive to borrow money. So for businesses, because the interest rates are higher, it means that debt is now costlier. And without access to low interest capital, businesses can't make as many investments or pursue new opportunities. And if and when consumers who are also strapped for cash because of inflation and higher debt payments, spending slows down, businesses will take on cost-cutting measures to protect their bottom line. Layoffs are very common during this time period, so you need to be aware of that. You probably are already hearing of some talk in your workplace about business slowdown, about cost-cutting measures. You want to listen in and plan ahead. You've seen in the news that big tech firms are laying off and slowing down their hiring plans. Some of this will trickle down to smaller businesses, and if you work for those smaller businesses, you need to be listening in and putting in a plan of action. The labor market was very hot at one point and it was at a record high, but there is a likelihood that the job market will be weaker in a few months. What this means for you is that job hopping to a new company for a better pay may not be as easy anymore. There's going to be stricter hiring controls. There's going to be stricter salary reviews, which is going to impact your finances. So it's good to be prepared if you are worried about job security. Bulk up your emergency fund, reconnect with old colleagues, and brush up that resume. If you do get laid off, I do have a longer video, which I will link above here and in the description, where we cover the 13 things you must do after a layoff. Yes, 13 things. You want to make sure you have a plan of action so that you get back on your feet. I have been there. I have been laid off myself, and it can be a very disorienting time. But if you have a plan of action in place, you can get back on your feet and find that next opportunity and set yourself for financial success moving forward. The next impact of the Federal Reserve increasing rates is increased market volatility. Now, as investors await news of the Federal Reserve's decision whether to increase or not to increase rates, you are going to see a lot of stock market volatility. Just watch the indexes when they are about to announce the Fed news. Here's the thing when it comes to low interest rates. Because it's easy and cheap to borrow money, it incentivizes risk taking and speculation, which is why when the rates were low, there was a lot of market volume, a lot of people investing because they're also trying to compensate for lackluster returns from other investments like bonds, fixed incomes, and CDs. So there was a lot of people playing the stock market, borrowing money for cheap, and trying to get gains from there. Now that the days of cheap money is over, you are seeing investors, and you might be doing the same thing, reshuffling your portfolio to take advantage of other opportunities. An increase in interest rates can make bonds more attractive to investors, which means people may be drawing down, maybe taking money from their stocks, and potentially leading to a decrease in stock prices. You will also see a lot of volatility as businesses begin to report earnings, and those earnings may not meet Wall Street expectations because of slowing demand. So you'll also see that volatility come from those missed expectations. What this means for your portfolio is that you are going to see a lot of up and down swings. And this is going to be expected, and it's good to be prepared and take on the long view. If you zoom out historically, data shows that the stock market has always risen over time. And the best performing portfolios are the ones that have the most time in the market. With that in mind, the best response to all of this volatility is to stay the course with your investing. Prioritize investing in low cost index funds and do it in an automated fashion so you are constantly and consistently investing. So, what are we to do? Well, there's a very common mantra that says, don't fight the Fed. Instead, focus on your household economics. Focus on the things you can't control. You can't control whether the Fed will increase or decrease rates. You can be aware of it and you can plan ahead. You can make a budget. that ensures you are saving and paying down debt. You can improve your credit history and score by making sure that you are paying down debt and also paying bills on time. You can continue to invest in the stock market for a more long-term view. Yes, the Fed's decisions and any of their policies do affect you and your money. But there's also a lot you can do with your own finances so that you stay in control. Thanks for watching, and I will see you in the next video. Bye.